The poor and middle class work for money. The rich have money work for them. This quote by Robert Kiyosaki perfectly encapsulates the strategy we're going to discuss today. It's a strategy that allows the wealthy to grow their fortune while paying minimal taxes. In this video, we're going to break down this strategy known as buy, borrow, die. I'll show you exactly how it works, why it's so effective, and most importantly, how you can start applying these principles to your own finances, regardless of your current income level. By the end of this video, you'll have a new perspective on wealth building that could change your financial future. Quick disclaimer from me, guys. None of the advice I'm giving you is tax, legal, or financial advice. Make sure you consult an advisor, as everybody's situation is different. And let's face it, I'm just a guy on YouTube who doesn't want to be sued by Joel from South Carolina. Now, what if I told you the first step to paying zero taxes is actually spending money? It might sound counterintuitive, but that's exactly how the wealthy start their journey to minimizing their tax burden. Let's dive into the first part of our buy, borrow, die strategy, buying appreciating assets. When most people think about building wealth, they often focus on saving money in a bank account or investing in a pension scheme. While these methods have their place, they're not exactly the most tax efficient ways to grow your wealth. Instead, the wealthy focus on buying assets that appreciate in value over time. So what exactly are appreciating assets? These are investments that are expected to increase in value over time. Think of stocks, real estate, or even fine art. The key here is that as these assets grow in value, you don't pay tax on that growth until you sell them. This is what we call unrealized gains. Let's break this down with an example. Imagine you buy $10,000 worth of stock in a company. Over the next few years, that stock grows to be worth $50,000. That $40,000 increase is an unrealized gain. As long as you hold on to that stock, you won't pay a penny in taxes on that gain. It's like having a $40,000 raise that the taxman can't touch. This principle applies to various types of assets. Real estate is another popular choice. You might buy a property for $200,000 and over time it appreciates to $500,000. That $300,000 increase isn't taxed as long as you own the property. And even better, you might be able to deduct the property taxes and mortgage interest, further reducing your tax burden. Art and collectibles can also fall into this category. While they might seem like luxuries for the wealthy, they're strategic investments. A painting bought for $1 million that doubles in value over a decade represents a significant untaxed gain. Now, you might be thinking, this sounds great, but I don't have millions to invest in art or real estate. The good news is you don't need to start big. You can begin with smaller investments in stocks or even fractional shares of real estate through real estate investment trusts. The principle remains the same regardless of the scale. But here's where it gets really interesting, everyone. You might be wondering, if I never sell these assets, how do I benefit from their increased value? I can't pay my bills with unrealized gains. That's a great question as well, and it leads us to the next part of our strategy. You see, the wealthy have figured out a way to access the value of their appreciating assets without triggering a taxable event. They've mastered the art of leveraging these assets to their advantage. Instead of selling and paying capital gains tax, they use these assets as collateral for loans. This brings us to the next step in our buy, borrow, die strategy. Now that we've bought assets and let them appreciate, let's see how we can use them to access tax-free cash. It's time to explore the borrow part of our strategy, where we'll unlock the power of leveraging assets for financial freedom. Picture this, you're sitting on millions in assets, but your tax return shows zero income. It sounds impossible, right? Well, that's exactly what some of the wealthiest people achieve through a clever strategy we're about to uncover. It's like having your cake and eating it too, but in this case, it's having your wealth and spending it, all while keeping the taxman at bay. Welcome to the borrow part of our buy, borrow, die strategy. This is where the magic happens, allowing the wealthy to access their money without triggering a massive tax bill. And the key? Borrowing against their appreciating assets. Now, you might be wondering, how is borrowing money better than just selling my assets? When you sell an asset, you create a taxable event. You have to pay capital gains tax on any profit you've made. But when you borrow against an asset, you're not selling anything. You're simply using your asset as collateral for a loan. And here's the kicker. Borrowed money isn't considered taxable income. Let's break this down with an example. Say you have a stock portfolio worth $1 million and you need $100,000 for a new business venture. If you sell $100,000 worth of stock, you might end up paying $20,000 or more in capital gains taxes, depending on your tax bracket and how long you've held the stock. But if you borrow that $100,000 against your portfolio, you pay zero in taxes. That's a potential saving of $20,000 or more. So how exactly does this work? Enter the world of asset-backed loans. Two popular types are pledged asset lines and securities-backed lines of credit. These financial products allow you to borrow against your investment portfolio without selling a single share. Let's take a closer look at securities-backed lines of credit. These lines of credit let you borrow up to 50 to 90% of your portfolio's value, depending on the types of securities you own. And the best part, the interest rates are typically much lower than traditional loans. We're talking rates as low as 2.95% in some cases. Compare that to the average credit card interest rate of around 16%, and you can see why this strategy is so appealing. But what about paying back these loans? This is where the strategy gets really interesting. Instead of paying off the loan in full, many wealthy people simply pay the interest and continually refinance the loan. As their assets depreciate over time, they can borrow more against them, creating a cycle of accessible, tax-free cash. Let me give you a real-world example, everyone. Let's say an investor borrowed $1 million at 2.5% interest rate against his investment portfolio. Instead of spending this money, he used it to invest in cash-flowing properties. The rental income from these properties more than covered the interest on his loan, and he's building additional wealth through real estate appreciation, all without paying a penny in taxes on the initial $1 million. Now, you might be thinking, this sounds great for millionaires, but what about me? The truth is, you don't need millions to start implementing this strategy. Many brokerages offer these types of loans with much lower minimum asset requirements. You could potentially start with as little as $100,000 in securities. Now, we've seen how the wealthy use the buy and borrow strategies to grow and access their wealth tax-free, but you might be wondering, what happens to all these loans in the end? Don't they eventually need to be paid back? That's an excellent question, and it leads us to the final, crucial piece of this strategy. We've bought, we've borrowed, but there's one final step that completes this tax minimizing trifecta. It's time to explore the die part of our strategy where we'll uncover how the wealthy pass on their fortunes while sidestepping a massive tax bill. You've heard the saying, nothing is certain except death and taxes, but what if I told you that for the wealthy, death could actually be the ultimate tax loophole? It sounds morbid, but it's a game changer in the world of wealth preservation. Let's uncover how the rich use their final bow to pull off the greatest tax trick yet. Welcome to the die part of our buy, borrow, die strategy. This is where the wealthy complete their tax minimizing trifecta, and it all hinges on a little known rule called the stepped up basis. Here's how it works. When someone passes away, their assets are revalued to their current fair market value. This new value becomes a stepped up basis for the heirs who inherit these assets. Now, why is this such a big deal? Well, remember all those unrealized gains we talked about earlier? The ones that have been quietly grown without being taxed? When assets pass to heirs with a stepped up basis, all those years of capital gains simply vanish. It's like hitting a reset button on the tax clock. Let's put this into perspective. Imagine a wealthy individual bought a property for $1 million and over the years it appreciated to $10 million. If they sold that property during their lifetime, they'd be looking at a whopping $9 million in capital gains. Even at the preferential long-term capital gains rate, that's a significant tax bill. But if they hold on to that property till they pass away, their heirs receive it at a stepped-up basis of $10 million. If the heirs decide to sell immediately, they pay zero capital gains tax. That's right, zero. This principle applies to all kinds of assets, stocks, bonds, real estate, even rare collectibles. The potential tax savings for large estates are staggering. Think about someone like Jeff Bezos or Elon Musk, whose wealth is primarily tied up in company stock. Their heirs could potentially inherit billions in stock and sell it all without paying a dime in capital gains taxes. But here's where it gets really interesting, everyone. How does this complete the buy, borrow, die cycle? Well, remember those loans we talked about in the borrow phase? The ones that allow the wealthy to access their wealth without selling assets. When the estate settles these loans, it's with the assets that now have a stepped up basis. This means the estate can sell assets to pay off the loans without incurring the massive capital gains taxes that would have been due if the original owner had sold during their lifetime. Even more powerful is what happens next. The heirs don't just inherit tax-free assets, they inherit a playbook. They can immediately restart the buy, borrow, die strategy with their newly acquired high-value assets. They can use these assets as collateral for their own loans, accessing wealth tax-free, just like their predecessors did. It's a cycle that can perpetuate for generations, allowing families to grow and protect their wealth with minimal tax impact. Now, you might be thinking, this sounds too good to be true. Surely the government is trying to close this loophole. And you'd be right to think that as well. There have been discussions about changing the stepped-up basis rules. Some policymakers argue that limiting or eliminating this tax benefit could increase tax revenue and address wealth inequality. Critics of the stepped-up basis say it disproportionately benefits the wealthy, allowing them to pass on large amounts of wealth without tax consequences. But for now, the stepped-up basis remains a powerful tool in the wealthy's tax minimizing arsenal. It's the final piece that makes the buy, borrow, die strategy so effective, allowing the rich to grow, access, and pass on their wealth while minimizing their tax burden. Now we've covered all three parts of this strategy, you might be wondering how it all fits together in practice. How does a family actually implement this over generations? Well, you're in luck. Next, we're going to walk through a real-world example that will bring all these concepts together. We'll see how a seemingly modest portfolio can turn into generational wealth, all while keeping the taxman at bay. What if I told you that $1 million today could become $1 billion legacy, all while paying minimal taxes? It sounds too good to be true, but that's exactly what we're about to explore. Buckle up as we dive into a real-world scenario that will show you the true power of the buy, borrow, die strategy in action. Let's start with the hypothetical family, the Garcias, who have managed to accumulate a $1 million portfolio of diversified stocks and real estate. Instead of following traditional financial advice to sell assets as they need money, they've decided to implement the buy, borrow, die strategy. First, the Garcias focus on buying more appreciating assets whenever possible. They reinvest dividends, purchase more real estate, and even dabble in fine art. Over time, their portfolio grows substantially, reaching $5 million after a decade of smart investing and compound growth. Now, instead of selling assets and triggering capital gains taxes, the Garcias set up a securities-backed line of credit. They borrow $500,000 against their portfolio at a low 3% interest rate. This gives them access to cash for big purchases or investments without creating a taxable event. They use this money to start a small business which generates income to cover the interest payments on their loan. As their assets continue to appreciate, they can borrow more. By the time the first generation of Garcias pass away, their portfolio has grown to $20 million. Here's where the die part of the strategy kicks in. The heirs inherit these assets with a stepped up basis, meaning all those years of capital gains are wiped clean from a tax perspective. The next generation of Garcias can now restart the cycle with a much larger asset base. They can borrow against their $20 million portfolio, invest in new opportunities, and grow the family wealth even further. Fast forward a few generations, and that initial $1 million could potentially grow into hundreds of millions or even billions, all while paying minimal taxes along the way. Now, you might be thinking, this sounds great, but what about the risks? It's a valid concern as well. This strategy does come with potential pitfalls. Market downturns can reduce the value of assets, potentially into margin calls on the loans. There's also the risk of over-leveraging if not managed carefully. And of course, there's always the possibility of changes to tax laws that could impact the effectiveness of this strategy. But when we compare this to traditional approaches, the potential benefits become clear. If the Garcias had simply invested their $1 million and sold assets as needed, they'd be paying capital gains taxes at every turn, significantly slowing their wealth growth. The power of compound growth is amplified when you can avoid triggering taxable events. It's important to note that while we've used a $1 million starting point in our example, this strategy can be scaled both up and down. Those with larger asset bases can potentially see even more dramatic results, while those starting with less can still apply the principles on a smaller scale. But here's where we need to pause and ask some tough questions. Is this strategy ethical? What about its impact on society? Critics argue that strategies like buy, borrow, die exacerbate wealth inequality, allowing the rich to accumulate vast fortunes while paying minimal taxes. They point out that this approach is primarily accessible to those who already have significant assets, creating a system where wealth begets more wealth. On the other hand, proponents argue that these strategies incentivize long-term investment and economic growth. They say that by keeping the capital invested in the market rather than paying out in taxes, these approaches can drive innovation and job creation. As we wrap up our explanation of the buy, borrow, die strategy, it's clear that while it offers powerful wealth building potential, it also raises important questions about tax policy and economic fairness. We've uncovered the powerful buy, borrow, die strategy used by the wealthy to grow their fortunes while minimizing taxes. By investing in appreciating assets, borrowing against them tax-free, and passing wealth to their heirs with a stepped-up basis, this approach can create generational wealth. As Robert Kiyosaki wisely said, the rich don't work for money, they make money work for them. This strategy embodies that principle, revealing how the tax system can be leveraged by those with knowledge and resources. Whether you're just starting out or already have significant assets, understanding these concepts can transform your financial future. Take the next step in your journey towards financial independence. Consult a financial advisor who can help you implement elements of this strategy in your own life. The path to building lasting wealth begins with education and action, and that also means subscribe to this channel. See you all in the next one.